Just think about what I'm telling you. If they withdraw $4.5 trillion that has basically been sitting on these banks' balance sheet since 2020, if they take out $4.5 trillion, do the banks have that $4.5 trillion? The banks don't have it because they bought the treasuries to insure it. Welcome, everybody. Welcome to this edition of this podcast, Crashes and Taxes. I am your host for the podcast, Rebecca Walser. So excited to be with you. I am in New York, as you can see this week. So it has been very busy this beginning of this year. And so I have not been able to do a podcast with you for a little bit. And today's podcast is going to be a little bit different. I most of the time do current events, and I do markets, and I do what's happening right now. But, I do that all the time. And, I started forming a kind of a theory in my brain. And I wanted to share that with you today. I thought that was going to be more of an interesting and unique take. And it started to sort of come together organically. So the first thing I was thinking is, the government shutdown, the continuing resolution that we needed to keep all of the financing going. Normally, I would be not so in favor of the government continuing to spend such an absorbent amount of money, because, to be honest, we are issuing $10 trillion of paper this year, the U.S. Treasury. And the reason we're issuing $10 trillion, I've gone over this before on a previous podcast, is 1.6 is deficit projected. It could be more, it probably will be more, but especially with this year and how it will turn out. But let's just say that what right now their projections are accurate, and 1.6 trillion is going to be just to fund the ongoing fiscal 2024 deficit. The other 8.4 trillion is rolling off debt. And specifically, this is something that Yellen directly, Treasury Secretary Janet Yellen, is being criticized for by other market insiders. And we are going to go through that in this podcast. But it occurred to me, if I would normally not want the government to have a continuing resolution to keep the purse strings being pulled and going without no end in sight, because clearly that kind of modern monetary theory is problematic and will and has already caused the demise of our fiat dollar globally in the world. But then I realized we actually do want the continuing resolution, because if the government had stopped, Janet Yellen, as Treasury Secretary, would have had access to all kinds of emergency funding measures. You would have her immediately able to implement emergency measures, and this would only continue or perpetuate or make even bigger the ability she has had to really create, and I'm not blaming her. I mean, this is an incredibly difficult job under normal circumstances. She left being obviously the Fed chair, which she wasn't there that long, to being the Secretary of the Treasury. And it is a very difficult job in the middle of a pandemic, and pulling in all of these funds and figuring out how to continue with this government with such large annual deficit spending needs and refinancing of debt needs. So I'm not blaming her or knocking her. However, I do want to kind of analyze what I think, economic theory that I've been bantering around in my brain, that this could actually be something that we don't want to happen. And I'm talking specifically about the Federal Reserve cutting interest rates. I am going to make the argument in this podcast today about why the Fed cutting rates could actually exacerbate the end of the fiat dollar, which doesn't make any sense at all in my my normal brain. Outside of saying that modern monetary theory and just constant expansive policy of monetary fiscal stimulus and monetary stimulus is just bad. So from that perspective, of course, we don't want it. But at the same time, there's another reason, and it's very technical and it's very specific to the banking in America. And that's why I want to walk you through it. But I really want you to stay with me. This is going to be really interesting. And I think for those of you that don't understand the banking sector and how it interacts, the Federal Reserve interacts with the Treasury, with the commercial banking structure that we have set up in America, I think that this will be kind of a really interesting podcast for you to understand all of that. So let's get started. And so I'm going to take I'm going to have to probably have myself off for a lot of this, because the first thing I want to point out is this is the deposits of all commercial banks. And this is and I'm going to give you this data a couple different ways, but you can see I've pinpointed here February 19th, 2020, because I just wanted a benchmark in the sand before the coronavirus stimulus started. Now, remember, coronavirus, I remember specifically being at a conference in DC and coming back and getting the email, hey, somebody at the conference was exposed to coronavirus, you've been exposed, go see a medical professional, whatever. So certainly we did not have government stimulus coronavirus related in February of 2020. And again, this is $13.37 trillion here in February of 2020. Now, if we bring that forward, I'm just doing this in 2-year increments. We're now looking at February of 2022, and we can see that we went up from 13.3 trillion to 17.99, or basically 18 trillion. So 18 trillion was really what was in all of the commercial banks in February of 2022. So that's 2 years post-pandemic, just almost. And that's where the deposits went to. And then if we look to see where we are this year in 2024, we see that we've barely come down. We've only come down not even a full 500 billion, because we went from 17,999, or let's call it 18, to 17,420. So you're looking at literally not even, or right around a half of $1 trillion, or $500 billion. So I make all these points to show you that the coronavirus stimulus is, as I said it was $10 trillion of total stimulus. Now, a lot of that was direct stimulus in the form of the CARES Act, in the form of deposits that were made through the tax system, all kinds of things. You've got the PPP, the Payroll Protection Program. You've got the ERC, Employment Retention Credit, which is the IRS program that right now has a ton of fraud associated with it and all of these things. And so you can just see that the amount of deposits greatly increased over these last 4 years, all related to really how we dealt with coronavirus. So let's go full screen on this. And I want to read this to you. This is a Board of Governors, Federal Reserve, understanding bank deposit growth during the COVID-19 pandemic. So clearly this is something that other, educated parties are questioning the Fed about, and they made a Fed note about it. You can see a notable development in the U.S. banking system following the onset of the COVID-19 pandemic has been the rapid and sustained growth in aggregate bank deposits. Total deposits at domestic commercial banks rose by more than 35% since the end of 2019 and stood at around 18 trillion as of the fourth quarter of 2021. Exactly as I read it to you on February of 2022, we were at basically 18 trillion. This rise in aggregate deposits is outsized compared to any period in recent history. As shown in Figure 2, the year-over-year percentage change in deposits since the first quarter of 2020 has exceeded any of those witnessed over the past 30 years. I just want to digress for a second and just make a note. Obviously as a business, we constantly advertise our services, and a lot of things that we hear back from our ads are, oh my gosh, the sky is falling, Rebecca, the sky is always falling. Everything's been fine. I know what I'm doing. I've been doing this for 40 years. And it's so arrogant. And I just want to caution you, don't be that guy or girl that has the arrogance to say, I'll be fine. Everything is fine. This is the end of the fiat system as it is literally playing out in front of our eyes. And there is nobody in America that has ever been through that, because the last time this happened was really back in the early 1900s when we really migrated in World War I from the pound over to the dollar. It wasn't official, but technically in World War I, that is what happened, because people started really leveraging America for war efforts and started paying in US dollars. And it just naturally started in World War I. Of course, we know that by end of World War II, we had the Bretton Woods New Hampshire Agreement, where basically the world agreed that the US dollar would be the global world reserve currency. So if you want to go off of that date, that was 1944, and you fast forward that to basically we had gold confiscated, as we know, by FDR in the 30s. And we weren't really technically allowed to own gold again as Americans until the 1970s. We went off the gold standard. We're allowed to own gold again, which is this an incredibly terrible period in U.S. history that people don't even remember about, that executive order of FDR turning all of your gold. And then when we were off the gold standard, we could start buying gold again. We had to quasi back our currency with an asset. And of course, that's where the petrodollar was birthed. So that was just a digression, but don't make the assumption that because you've been investing for 40 years, you've been living your life and everything's been fine and you've built up your 401k. A lot of times we talk about a tax message with people trying to educate the American public as to the fact that the 401k being pre-tax traditional, not the Roth, is a tax trap based on the government's. We only have one federal government analysis conducted by the Congressional Budget Office in 2008 as to what the tax rates will be once the baby boomers retire. We don't have a ton of resources that we can reference to say, here's what it says. But the federal government was honest in 2008 and said, CBO said that middle class tax rates will need to be 63% based on their calculations if we are to pay the baby boomers all of the benefits they've been promised just on Social Security and Medicare. Now, that was prior to coronavirus happening. That was prior to all of this information I'm about to give you today. And that just exacerbates and makes worse that point of tax rates being in the 63% range for middle class, not better. So again, please don't be one of those arrogant people that just wants to close off your mind because you don't want to hear that maybe your 401k traditional pre-tax investing isn't the best thing that's going to serve you well throughout your retirement years when we're going through a debt crisis in America. And maybe you don't want to hear that there's a black swan coming because you can't accept the fact this is the end of the fiat system that's playing out before our eyes as we know it. That is what is happening. Even though it's difficult, I keep doing this job week in and week out because I know my vindication is coming, and I have a really, ability to just stand firm when I know, even if I'm the only one saying it's going to rain and I'm building an ark like Noah and everyone around me is laughing. I know that when the rain does finally start, I'll be inside the ark with my little, clan and my pack, and we're going to be safe. And I'm trying to get as many people on that ark as possible before it's too late. And people laugh and they mock and they say, oh my gosh, you're always saying there's a black swan coming. It's like, no, I haven't always been saying that, but let's be honest, since 2020 and the steps that the US government has taken, the Federal Reserve has taken, the Treasury Department has taken since 2020, yeah, that is the track that we are on. I have been talking about it for these last several years, and I'm going to keep talking about it because you are going to see it come and start in this 2024 year. It is going to happen. So I keep staying with it and being forthright that this is coming. All right, so let's keep going. This is the chart they were just talking about. What you can see is that basically this is a percentage. So I really can't stand the fact, and all of these graphs do this, you'll notice. I'll go back to the St. Louis Fed graphs in just a second, but you'll notice that all of these graphs literally inject a line directly in 2020 so that the line is obfuscated. So you can't see it, but literally the money on deposit at US commercial banks went straight up. And that's that 35% year over year change from 19 to 20, 35% increase. Now you'll notice that in Q4, and this is of 2022, I believe, no, 2021, you'll notice that it looks like it's dropped a tad. No, this is a percent of increase above. So what you're looking at is still that we're still 10% above the previous level from this line here. Let me just go back to the Federal Reserve and let me show you. You see this line here? They do it on this graph. You see how they inject this line. The line is to indicate recessions, basically depressions, recessions. And because coronavirus, because of the stimulus, wasn't one, they indicate the line here for coronavirus, but you really can see the bank deposits just jumping astronomically. And every single time you look at a chart for this time period, you're going to continue to see this line, which obfuscates really how much the money supply, or excuse me, the bank deposits did go up. So let's keep going. And let's just note in this note, we present evidence that 4 factors can largely explain the growth in bank deposits over the 2-year period from 2019 Q4 to 2021 Q4. So this is a Q4 2021 graph. The initial spike in commercial industrial C&I credit line drawdowns. So basically what this is saying is that when the pandemic first started, not knowing how the Federal Reserve or the Treasury was going to respond, you had a lot of banks, you had a lot of businesses that went out and drew down their credit lines. They actually basically took advantage of the fact that they had revolving lines of credit outstanding and were able to get capital from that. And they went ahead and executed additional capital from those lines. So you saw that money came into businesses, corporations through them drawing down their credit lines the second the pandemic started, because they didn't know how the government was going to handle it. The second thing they're saying is asset purchased by the Federal Reserve. That is very important. We are going to come back to that. The third thing is large fiscal transfers to households more likely to hold savings in the form of deposits. So this is stimulus. This is government stimulus. As we shut down, the government's pushing money out to get economic activity and consumption still happening, even though we're going to be shut down. And then you can see here for a higher personal savings rate. Well, yeah, if you can't travel, can't go to the movies, can't go to your sports, can't go to restaurants, can't go to your bars, if you can't do anything because you're in lockdown, then you're going to be saving that money because you're not spending it on experiences, on services. And although some people obviously did spend money on staycations and upgrading the house and all those things that they did do when we were in the lockdown mode of 2020. I want to show this full screen here. This is the Federal Reserve statistics at a glance. And I know it's hard to read, but I really want you to see this is FDIC. This is all about FDIC. And I want you to see some of these numbers. So the first thing here is if you look at 2019, you can see, and this is March, This is as of March 31st, 2020. So look at the top where it says historical trends as of March 31st, 2020. This is only going through March of 2020, right before the stimulus actually started, because that's when coronavirus came forward, as we publicly know. It was here really at the end of 19. We just did not know it. So in the United States, I'm talking about. So you can see in 2019, we had 13.2 trillion. And then literally in March of 2020, we are at 14.3 trillion. So that was where we were right before coronavirus. Now, I really want you to come down here and look at this specific deposit insurance fund. You can see the fund balance is 113 billion. So just keep that in mind. The FDIC actual reserves for the FDIC is 113 billion. You can see the amount of insured deposits are 8 trillion 169 billion. So $8.2 trillion. So in other words, of all of the 14.3 trillion that is deposited in banks in America, 8.1 of that, or 8.2 of that, is actually FDIC insured. However, the reserves that FDIC has as of March 2020 is only 113 billion, meaning making a reserve ratio of 1.39%. In other words, we only insure 1.39%. That's all we actually have in way of insurance. If we were to have a bank run, our banking system would be an immediate failure. When we talk about fractional reserve banking, when I've said to you that the banks are insolvent by design, this is what we're talking about. We're talking about that in March of 2020, The world had over 14 trillion in deposits on record prior to coronavirus stimulus. And of that 14 trillion, only 8.2 trillion was actually considered FDIC insured. Everything else would be the deposits that exceed 250,000, the deposits that are not able to be insured because of whatever reason, non-traditional accounts, all kinds of things that not everything is insured, mostly excess amounts in accounts, I can tell you guys. But so that's about 6 trillion that's not insured. But the reserve ratio of actual Federal Reserve assets to pay in the event of banking collapse is only 1.3 or 1.4%, which basically means our banks are insolvent completely. We rely on the good faith of Americans believing in the banking system, believing that the government will step up and do what they need to do to solve any problems and crises like they did in 2020 when these things come. So that is the picture of our banking system prior to the stimulus. And then, of course, once the stimulus came, we understand kind of like literally where things were going. Now, this is an article out of the New York Times, and this was August 25th of 2021. And I want you to understand a shift that began to happen. And it's kind of the beginning of this economic theory that I'm really bantering in my head and working on and trying to see, is there something I can bring to you of utility that will help you understand as these things come, why it's happening, what is happening, what has happened. And so this is literally a year and 5 months into stimulus, because stimulus started in March 2020. So you're looking, banks are binging on bonds, but not because they want to. And then you're like, well, what does that mean, Rebecca? What is it? What are you talking about? Banks are awash in deposits, and their customers are taking out fewer loans. So they have little choice but to buy up government debt, even if it means skimpy profits. So what this is basically pointing out here in the New York Times from August of 2021 is that normally when banks take in deposits, the way they make money is they say, oh, we'll pay you nothing. Basically, for the last 15 years, it's been basically no return at all, because rates have been so low. And yet we'll lend out this money in the form of a loan, and we'll charge 4%, 5%, 6%, depending on what the risk is and what the loan proceeds are for. We'll charge you in this 4 to 6% range, 3 to 6% range, depending on your credit grade and what you're doing. And we aren't paying hardly any money on deposits. So we're making all this net interest yield or net interest spread. And that's how banks make their money. However, when the deposits that, again, we saw, and I read that Federal Reserve synopsis, when the deposits went up almost 50%, 35% in such a short amount of time, well, the banks are facing a dilemma. Number one, we're shut down, we're locked down. So there's not going to be a lot of economic activity looking for loans because businesses are shut down, individuals are shut down. So there's not a lot of economic activity. And all this, we're flush with all this money, but people aren't not wanting to maybe take loans out because the economic activity is diminished. But the other reason that banks didn't want to make loans is because it was extremely risky. If the economy is shut down, if the world is shut down, if we've got a global pandemic, and we've got all this massive cash and we can't lend because there's not a lot of economic activity, the question is, do we even want to lend? Because we need to tighten our lending standards right now because we're in the middle of a global pandemic and we don't know what's going to happen. So you saw two things happen. You saw less economic activity to request a demand and financing and therefore less capital need. And you saw that because it was in the middle of a global pandemic and a global shutdown, that banks were tightened their lending standards and were a lot more cautious about exactly the type of borrower that would be able to, qualify for their commercial loans. So what you had was the inability of the banks to normally have normal bank operations where they would continue making loans as normal. And so if they can't make loans, they can't just sit with that money on their balance sheet those are liabilities to a bank. So they always need to invest the cash to be making some kind of return because these are liabilities to these banks. And so what the point is of this article is that is exactly what banks did. They shifted their main focus from lending and switched it to investing in short-term treasuries to basically protect their deposits. The assets that they bought to offset their liability of the deposits they had and they were holding was treasuries. All right. So that is a shift in how banks would normally react. I mean, they've always been a part of the Federal Open Market Committee operations, and we're going to go into that at the end here. But I just want you to understand this is a shift that was caused, in fact, by the pandemic, by massive excess deposits from less economic activity, less lending. And so now the banks have to deal with how are we going to insure these deposits since we're not making these loans. Now, you have this article that's from Seeking Alpha, and this is from just October of 2023. And I want you to understand some criticism of Treasury Secretary Janet Yellen. I'm not stating whether I agree with it or not. However, we definitely have seen a shift in Yellen from refinancing debt with longer term notes and bonds to shorter term Treasury bills. And that is unusual. And that is the point that Druckenmiller basically made here about Yellen. So let's just read this article. This is from just October of 2023. This is in Seeking Alpha. Secretary of Treasury Janet Yellen made the biggest blunder in the history of the Treasury when she did not secure long-term U.S. debt at low interest rates in 2021, said billionaire investor Stanley Druckenmiller. The former chairman and president of this Dunks Capital told Paul Tudor Jones, founder of asset management firm Tudor Investment Corporation, at the JP Morgan Robinhood Investors Conference last week that while every American household and business managed to refinance their I lost that. Yellen basically didn't. She basically did not refinance the Treasury debt at the short-term, longer-term rates. She instead was issuing the shorter-term Treasury bills instead of the notes and bonds. That mistake, Druckenmiller said, has set the environment for the U.S. debt crisis that exists today. Yellen, who was appointed Treasury Secretary in January 2021 and had served as the chairman of the Federal Reserve from 2014 to 2018, so only for that period of time, was issuing 2 years of debt issued by the Treasury at 15 basis points when she could have issued 10 years at 70 or 30 years at 180. In other words, she said, well, gosh, debt is so cheap and I expect it to remain cheap. And this is where she went wrong, economically speaking. For her to not understand that after the total accelerated stimulus for coronavirus from just the United States, between federal fiscal stimulus and monetary stimulus, was $10 trillion. And it is impossible. We have never had anything in the history of time like this. It's impossible to have that much stimulus and not see interest rates go up. It's impossible. So she made the wrong bet. And this goes along with her saying the entire 2021 that inflation was transitory. It's almost like she was trying to drill in the point that she believed inflation was transitory because she continued to finance at short-term rates instead of the longer-term rates that she could have locked in for longer for much lower. Druckenmiller said he has no idea why she hasn't been called out on this. She has no right to still be in that job after that. He said that if interest rates continue where they are, the government's yearly interest expense will reach 4.5% of GDP by 2033, 7% by 2043, and that would be the equivalent of 144% of annual discretionary spending today. Today, because of pent-up demand, fiscal and monetary stimulus, and shortages due to the pandemic, inflation hit a 40-year high in 2022. As interest rates seem to stay higher for longer, north of 5%, the U.S. debt has surpassed $33.6 trillion. Again, this is in October. We're at $34.4 trillion, while U.S. federal spending is more than $6.1 trillion to $6.2 trillion a year. And that is unheard of. We were in the fours before coronavirus. $4 trillion a year was our budget. Now we're in the sixes, and we're not, even though we are funding Ukraine and Israel, we're technically only not in the middle of any kind of global war. So why are we having pandemic level, war level spending of over $6 trillion in a 2023 year? The politicians that are telling you they're not going to cut entitlements, it's just an outright lie. He said the numbers absolutely don't work. It is a fantasy. That's not really the point of this podcast. The point of this podcast is to let you know that Yellen was in 2021 issuing short-term treasuries 2 years, 1 year at the low rates that we had instead of locking in 10-year and longer term notes and bonds that would have prevented us from having to refinance so much. But because she did it that way, we, again, as I talked about at the very beginning, have to refinance. And this is not all because of her short-term financing. Some of this was already coming due, but she certainly added and created this 8.6 trillion monstrosity of debt that has to be refinanced now at much higher rates that the US Treasury and the American public cannot afford to pay. In other words, our interest is exceeding now this year our defense spending alone. Our singular interest expense will be larger than our expense on the military and the Department of Defense. That's the first comparison. The singular interest expense also now exceeds what we spend on healthcare, Medicare. It doesn't exceed them together, but it exceeds them both individually in this year, 2024. So Yellen expected things to be temporary and transitory. They weren't. They aren't. It couldn't have been after $10 trillion. That's a basic economic lesson. And so now she's having to reissue these maturing short-term treasuries into longer term at much higher rates. And this is why you're hearing everybody say, with the inverted yield curve, with the 2-year being higher than the 10-year, that the Fed must cut rates. But stick with me here because I'm going to make this point to you and you're going to be like, oh my goodness, I see what you're saying, Rebecca. Like, could this be what actually triggers? I don't think so, because I think we're going to have this happen before, but let's keep going. All right, now you've got this Wall Street Journal article, and this is from September 20 of 2020, so 9/20/2020. You can see the same thing I'm telling you. We're not going to make loans. We're going to pile into treasuries. Banks pile into treasuries, helping to fund the government borrowing spree. So let's just take the numbers. If we went from basically 13 trillion in 2019 in commercial deposits to 18 trillion in 2020. And since then, we've only come back down, and I'll show you this number again, because here's the number of February of last month. In February of 2024, we had 17.4 trillion. So we've gone up 4.4 trillion, okay? The banks haven't been lending that out in the form of loans to the normal extent that they have. So much so that both the New York Times, and the New York Times article was in, again, 2021, August, and just the Wall Street Journal in September of 2020, both talked about the change in banks and how they weren't making loans, but instead they're going into treasuries. Now, think about this. If you have an increase from 13 trillion to 17.5 trillion, that's $4.5 trillion that have been going into deposits that the banks have not been lending out, but have instead gone and bought treasuries, short-term treasuries that expire in 1 to 2 years. So this is the short-term treasuries that have been bought. Now, people have been keeping their money inside of banks because of the fact that rates are so high. So on your savings account, not in a CD, but just on your money market that is insured at your bank. We're not talking about money market funds at a broker dealer or some kind of investment manager. We're talking about at an FDIC insured bank. Your money market, your savings, your checking, all of these things are FDIC insured up to the $250,000. So people feel good about this. They feel like it's a risk-free rate of return that they're going to get by just keeping money in the bank. And therefore, we have $4.5 trillion as of February of this year. So just last month, just 2 weeks ago, we have $4.5 trillion that basically hasn't been lent out, but the banks have bought treasuries to insure those deposits because they're not lending the money out. You can see demand from banks and money market funds help absorb the flood of new debt. So what's happening is, as Yellen has to reissue $10 trillion, 8.4 is being debt that's coming due and has to be refinanced. Like I said, she's doing short term. And then 1.6 is the actual deficit for 2024. So what's happening is, as these deposits are going up, the Treasury Department has had it really easy because the banks have been the buyer of these new treasuries, short-term treasuries. And so it is funding the government. It's absolutely astronomically insane if you think about what I'm about to tell you. But the Federal Reserve creates coronavirus stimulus, creates money, adds money, creates money supply. That's what they do. They send that out among the masses. The masses take that extra money. They're not got a lot of economic activity going on. They deposit it. It has stayed in deposits for it has for 4 years now, because we're talking March 2020 to February 2024. It stayed there because interest rates are high. Stayed there for the first 2 years, not so much because of interest rate policy, because it's just economic activity being shut down globally and taking a while for the engine of capitalism and market innovation to come back. So for the first couple of years, people just didn't spend the money. And then the second couple of years, the rates were raised so high. We started our interest rate raises in June of 2022. Last raise was July 26, 2023. So because rates are so high, people perceive this as risk-free. Now you've got $4.5 trillion that has been staying in banks, commercial banks in America. So I know I'm going through this painstakingly slow, and I apologize, but I want you guys to understand what I'm about to share with you. So you have all of this $4.5 trillion that has remained in banks, hasn't been lent out, and instead has bought treasuries, helping to actually fund the shortage that Yellen has been seeing. Now, I need to read this, and it's going to be a little bit tough, so let me just make this. Banks typically buy treasuries in the 1 to 5 year maturity range. Analysts said longer-term bonds are generally less appealing because they are more volatile, which means they're more subject to interest rate volatility, while shorter term debt barely offers more interest than what banks can get from their own reserve accounts at the Fed, if the basically the overnight repo market. So basically, money market funds have also received huge inflows, as many, and these are the funds that are not FDIC insured, as many investors move out of riskier investments and into cash. So this was just a trend. Let's move out of the stock market. It's going to crash. Let's move into cash. We'll do money market funds, or we'll go into a money market at our actual bank. Most of that has gone into government money market funds, which invest only in treasuries and other government-backed securities. It used to only be treasuries. They added basically government-backed securities, which really, again, are treasuries. But it was really to cover the mortgage-backed securities, the MBSs. But managers of prime money market funds, which can buy a wider range of short-term, and that's why these are not FDIC insured, short-term debt, also have increased their holdings of government debt. Together, both types of money market funds have lifted their holdings of short-term treasury bills, which carry a maturity of up to 1 year, by more than 1.3 trillion since the end of February. So this was just letting you know that literally banks, just from February to September of 2020, increased their treasury holdings by $1.3 trillion. Just in that fast of a time. So this is definitely a shift in the way that banks are absolutely and have performed their insurance requirements for all the deposits they hold. So much cash flooded into the funds that for a short time before the Treasury started issuing new debt, yields on Treasury bills actually went negative. Some government money market funds, such as ones run by Fidelity, stopped taking new money or money from new investors because of concerns that they would not be able to invest it. So I want you to know there is a breaking point, and you can see that Vanguard basically hit it in 2020. Now let's go through this. This is a tweet from October of 9 of 2023. U.S. Treasury Secretary Yellen says businesses and households are coping well with higher borrowing costs. This is from Financial Times. This is an interview she did with Financial Times in October of 2023. Yellen rejected concerns that banks could suffer a repeat of the turmoil earlier this year. And this was, again, the spring of 2023. That was the 3 of our 4 largest bank failures. The 4 largest bank failures in the history of America have occurred since the global financial crisis. Our largest bank failure was Washington Mutual in 2008. They were a huge lender in the subprime BC credit world, and that's why they failed, frankly, in the global financial crisis. But 3 of the 4 largest bank failures occurred last year, and that was, of course, Signature Valley Bank, SVB, I lost my First Republic, and the other one will come to me. So basically, we have had 3 of the 4 largest in 2023, and that's what it's talking about, that Yellen rejected concerns that banks could suffer a repeat of turmoil earlier this year, followed by a sharp jump in borrowing costs. That does not resonate with what is actually happening, because now we have the Federal Reserve putting in their minutes this year in writing that, in fact, that there will be additional bank failures in 2024 and that we should expect it. All right. And then the last point I want to make before I finally give you my legal theory, or my economic theory in this case, the Board of Governors of the Federal Reserve System, and there's a current frequently asked questions, and it says, why doesn't the Federal Reserve just buy Treasury securities directly from the U.S. Treasury? So instead of involving commercial banks, why doesn't the Fed just say, hey, we want to stimulate the economy, you need to pay debt, you've got to, spend a lot, Yellen, we'll create the money and just buy the Treasury directly from you, which cuts out the middle third-party commercial banks completely from our system. So let's read what the Federal Reserve says here. The Federal Reserve Act specifies that the Federal Reserve may buy and sell Treasury securities only in the open market. And that's the reason. What does that mean? Let me explain it. The Federal Reserve meets this statutory requirement by conducting its purchases and sales of securities openly, or chiefly through transactions with a group of major financial firms, so-called primary dealers, that have an established trading relationship with the Federal Reserve Bank of New York. These transactions are commonly referred to as open market operations, are the main tool through which the Federal Reserve adjusts its holdings of securities. Conducting transactions in the open market rather than directly with the Treasury supports the independence of the central bank in the conduct of monetary policy. Most of Treasury securities that the Federal Reserve has purchased has been old securities that were issued by the Treasury some time ago. The prices for new Treasury securities are set by the private market demand and supply conditions through Treasury auctions. So basically what they're saying is, we don't have a totalitarian system where our central bank and our Treasury are one and the same. No, we have an independent central bank, which is the Federal Reserve, separate from the government Treasury. That's the government. This is a central bank. It's not a part of the government. It's independent. And we use the open market operations of commercial banks to execute and effectuate market transactions and market operations. And so what they're basically stating is, we are not totalitarian. Our central bank is not part of our government. And we use commercial banks to determine supply demand of open market operations. But the truth is, in this instance, all of that collapsed down into the summary of what I'm going to tell you now is my economic theory, and why I'm super concerned that we could, in fact, wish our own collapse upon ourselves as we cut rates. And so what I am theorizing is, just like it occurred to me that actually I do not want the House to not pass a continuing resolution to keep the government funded, because that will then give Yellen again access to all kinds of emergency measures, while she will just be a kid in a candy shop and go hog wild crazy, which will only perpetuate this demise of fiat to be longer. It'll take longer if she can, do all these open market emergency measures, because the government's not funded. So we didn't want that for her. And then I realized, do we actually want rates to be cut? And the answer, of course, for us as retail investors, as retail consumers of debt, credit cards, auto loans, all of those things, all revolving line, of course we want interest rates to go down as consumers. But when you step back and think of this as U.S. tax-paying Americans, and do we want the Federal Reserve and to cut rates? I think that the answer could be no. And if you think about why, it's because this is an unprecedented level of expansion of deposits in our bank. And think about what is going to happen when you have the stock market starting off 2024 as well as it has, even though this week we are seeing some indications that the market is recognizing that NVIDIA isn't going to pull up all sectors for the entire 2024 year and just make everything beautiful. Even though that is something that the market is starting to seem to recognize. That being said, the market is doing quite well. And most, even though we did have consumer sentiment from the University of Michigan drop, it was the highest inter-month drop from February 14th to end of February. We literally dropped from 79.6 on the consumer sentiment to 76.9 as the largest inter-month drop since March of 2020. And so you do have people that are super concerned that are waiting for rates to be cut. But guess what? There's $4.5 trillion of capital in these banks that have not been lent out, but it has bought treasuries. So let's say that the Federal Reserve does cut rates, and let's just magically say that they are somehow able to cut 300 basis points and we get back somewhere into the twos. So now the banks are paying 2% risk-free rates for doing nothing and just parking your money. Well, that $4.5 trillion is going to very quickly, in my theory, start to exit the bank because you've got a stock market that looks great. You've got the Wall Street propaganda machine that says that it's a soft landing, it's a Goldilocks scenario, it's just right, everything is just perfect, and there's no landing at all, not even a soft landing. And we're just going to keep going right up from here, up, and away. We're going to ride that NVIDIA rocket to the AI moon, you know. And so people are going to say, gosh, I was getting 5%. Now I'm going to get 2.5%. That's no good. I'm going to take my money out and I'm going to go invest it in NVIDIA, in the stock market, in the S&P 500, in QQQ. I'm going to buy the NASDAQ, whatever people are going to say, they're going to say, I can't get 5% risk-free anymore. I'm just parking my money, or 4% or whatever the current, money market rate is, somewhere in the fours. I can't get it anymore. So I'm going to take my money out of this and I'm going to go back and buy, a longer term note that is at a higher rate, guaranteed, if they want risk-free, in theory, or I'm going to invest in the stock market. And most people are going to believe the Wall Street propaganda that a soft landing is going to not even happen. We're going to have a Goldilocks and there's going to be no landing. Everything is fine. They're going to want to take that money out and move that into the stock market. Now, just think about what I'm telling you. If they withdraw $4.5 trillion that has basically been sitting on these banks' balance sheet since 2020, if they take out $4.5 trillion, do the banks have that $4.5 trillion? The banks don't have it because they bought the treasuries to insure it. So you could look at the withdrawing as interest rates get cut of that excess $4.5 trillion. That alone could cause a bank run and our banking system to collapse. We probably don't want the Federal Reserve, from a perspective of the solvency of our banking system. It would be a crisis of massive proportions, as I'm economically theorizing this, if our banking system has its risk-free rate of return purely because of where the Federal Reserve has raised rates to. It would be a massive problem. It could create the actual bank run that undermines our solvency. And there is war drums and war beats of cut the rates. And we know that Powell has turned hawkish and that he is looking for any reason to not enable this Treasury to continue to go out and spend money so carelessly. So literally, we have a fight internally behind the scenes. Nobody really understands this, but there is a fight between what Powell believes as a hawkish trained attorney, not economist, not a PhD economist, and Yellen, who's trying to run the Treasury and basically expand this, the budget to just war and pandemic levels since 2020. And so I think what I'm trying to let you guys know is that the Fed cutting the rates in and of itself could create the collapse of our banking system based on the unprecedented level of $4.5 trillion being in the banks, not lent out, not coming back in forms of economic growth that has spurred additional growth. I mean, this is a consumption-based economy. You must be growing more than you're inflating your money supply. You can't inflate your money supply and not have growth. The risk-free rate has to come from the actual capitalists that run businesses that actually create growth and expansion in our economy. And that is not happening since 2020 because we have had anemic growth. We've certainly grown faster in interest rates than we've grown in GDP. That's negative. And that is why we really are in a recession, even though the numbers don't bear it out, because they're trying to obfuscate that fact. So I just want you to understand that there are so many factors that have not been walked through economically as to what the repercussions will be when we cut rates. It's not just that we have to cut rates because we can't afford to refinance $10 trillion at the current high rates. It's the fact that the very cutting of the rates could, in fact, undermine the solvency of our banking system, since it has had to absorb the monetary and fiscal stimulus that have been promulgated by coronavirus. So this is a really precarious time, you guys. And again, I would take the Federal Reserve's minutes where they state in writing, there will be another bank failure. I would take that at face value and judge what you should be doing accordingly. Certainly would not wait for the run of the cash out of the banks once the Fed does cut rates. And for this week, that is all I have for you guys. It's a cautious time. Stay cautious and take care, everybody. Bye-bye.